Hello, Ray.
Hey,
Welcome to the pilot.
thank you. Busy just trying to wrap up a couple of things here. You give me half a second.
Absolutely. Meanwhile, I was chatting up the co-pilot.
Oh, nice.
Asked her a couple of tough questions,
Yep.
and as expected, the answer was, of course, um, that the best way to get diversified, higher than usual investment income for Canadian investors is exchange traded funds.
Okay.
And and then I threw in a curveball. I'm not a baseball player, but I kind of understand the rotation. So we threw an ETF, CEF, artificial controversy on Penny Foxford and our Game of Yield hostess. And sure enough, we were at the point when we were discussing, the giants of economic thought who all noticed the anomaly. And as the original dividend detective, uh, you could probably explain to viewers, future viewers, and people who might log in into our live podcast on YouTube, um, what's the difference? Where is the advantage? And what exactly was the explanation that this giants of, economic thought noticed in closed-end funds and were trying to explain? Over to you.
Okay. Well, a couple of things. So closed-end funds and ETFs are similar in their structure in that they're simply a basket of investments. So let's get some basics down. So it's really a basket of investments, and that basket can contain anything from very thematic approaches like technology. It could also be sectors, gold, mining, what have you. So they're really just a collection of stocks in a basket, similar to a mutual fund. The difference between closed-end funds and mutual funds is that you can trade both closed-end funds and mutual funds throughout the day, like you can a stock. Mutual funds only trade at the end of the day when what they call a net asset value is printed or struck. They strike what they call a NAV. The NAV is simply the assets less the liabilities. You end up with a number. Let's call it $10. Within the ETF space, that NAV can change through the day as each underlying position within the ETF fluctuates. So there could be situations where the NAV, or rather the price, could be at a premium or a discount to NAV, which means it could be at a higher price than what it's actually worth or a lower price. But the market participants that create and destroy ETF units, they try to keep it as close as to NAV as possible. When we get to the closed-end fund universe, there's a big difference. So closed-end funds, they don't, they're issued as a stock in that there's a limited issue when it's sent out to market. So if there's 10 million shares of a closed-end fund, there's 10 million shares. To issue additional shares, the underwriter would have to come and do what they call a secondary offering to bring more units to market. With mutual funds and closed-end funds, or sorry, with mutual funds and ETFs, it's just an ongoing prospectus, so they can just keep issuing over and over, create units, take away units, and so forth. What happens in the closed-end fund space, and this is where the anomaly is in a lot of cases, not a lot, but let's put it this way: there are a lot of situations where you can actually buy a closed-end fund at a discount to the actual net asset value. So in other words, I mentioned $10 just a few moments ago. Let's say that the net asset value is $10. There are opportunities where you can pick up that closed-end fund at a discount. So let's call it $9.50 for argument's sake. So what in fact you're doing is you are buying $10 worth of assets for $9.50. So Warren Buffett is very famous for this phrase, stocks or socks on sale, buy it. So in this case, you can actually buy the closed-end funds essentially on sale. Now, people will ask, why is it at a discount? Well, there's a lot of things that are in play here as well. Some closed-end funds do use leverage to enhance income from the closed-end fund. So what'll happen is, because there's some leverage involved, there could be a discount, or what people will perceive as risk. If it's managed properly, actually leverage isn't bad. ETFs also have leverage. Some ETFs do have leverage plays in them as well. There's a lot of income-driven ETFs that apply gentle leverage to enhance income for the client, and in some cases actually also write options against them. So the anomaly at the end of the day between all of them is that closed-end funds can be purchased at a discount. Sometimes they trade at a premium as well, and when they trade at a premium, it just shows that people really want whatever it is within that closed-end fund. Let's call it an income-driven portfolio. They want that income from a specific sector. Let's call it banking, and that's how it comes together. So I hope that in a long roundabout way, I hope that answered your question.
Well, the answer is trying to cover all the grounds, all the points, and also what we have here, and what I'm sharing the screen. I'm hoping you see it, because the pilot is supposed to have some technical glitches. It's not an excuse, but can you see the screen which says knowledge pays the best dividend, express interest?
Yeah, I see that.
All right. So obviously it's Benjamin Franklin, the guy on a $100, greenback. American things are not very popular, but that's at the moment in Canada where we are. But this is a well-known expression, and the knowledge that we share, you and I, is not very common, is it, in Canada?
No, I'd agree. There's a few players out there that I know of that are doing what we do. I think the difference is, and when we first started our journey, Yuri, we did this on a manual basis. So we would seek out those discounts from net asset value for the closed-end funds manually. So we'd have to compare it market price against against the actual NAV of the fund. What we ended up doing together was making it systematic and automated. So now what we've got is we screen the closed-end fund universe and actually look at it very quickly and find those ones that are at a deeper discount. And in fact, we're buying the ones that are most out of favor. So the ones with the widest discount, looking for that discount window to close. So let's get back to that $10 example. Let's say that closed-end fund I mentioned was historically at $9.50 from a price perspective. That's kind of the spread between net asset value and market price. Sometimes that can widen. If it gets down to say $9 or under $9, you could buy that and then watch that discount close again. So let's say that it dropped down to $8.50, which is a $1.50 difference from the actual market price, or net asset value rather. Then that could close to $9.50. You can actually pick up that $1 as a capital gain. In the meantime, you'd also be collecting the income from that closed-end fund. So to answer your question, or to answer the question for the audience, yeah, we used to do this manually. Now we've got a systematic process. It's called, to throw some industry terms around, it's called statistical arbitrage, or stat arb. We've automated the process and modified it in many respects. And as you're well aware, we celebrated our 5th anniversary with our index called Top 50.
That's correct. And it was on the 20th of January. Interestingly enough, it was Trump's inauguration.
Yeah.
And I don't think, looking back, not very, you know what? If we have a reason to celebrate, it's our 5th anniversary. The other one, that's the same date. We have nothing to do with it. But you know what bothers me is that our co-pilot, and I already explained, I've been talking to co-pilot. Co-pilot knows that it's in character. It's like Stanislavski method. You live the life of the character you play. So co-pilot is now a co-writer, co-host, and a designated fact checker. And about 10 minutes before you logged in, I asked the lady, whose name is Penny Foxford, and she's a female fox, right? You know her. And I asked the question, can you lie? And the answer was unequivocal no. So the next question, and you were already there, was, are there any ETFs of CEFs? I thought that if we want a vehicle which gives you income stream and diversification in one ticket, in what we call one vehicle, and what I call it one and done, right? And I know one and done is a big thing. You're not supposed to put all your eggs in one basket, but we will talk about our index later. It's 5 years old. We also back tested it to 17 years ago, and a little bit of that later about back tests and how we pick them. But the interesting part here is, and I'm circling here, that I asked if there's ETFs of CFs. In other words, is there any other index? And index is normally what is under the ETF. Every ETF has a methodology, how they pick their stocks or bonds or whatever it is, right? Called the underlying. And they found two ETFs. And we are familiar with both of them. SABA is an ETF. This gentleman are in New York. He is a former bond trader, I think, of Deutsche Bank. Amplify is an index under the YYY ETF. And Penny missed PCF, which is S Composite Index. So there are three indices of which our fact-checking hostess is aware. Why do you think she missed ours?
Well, I mean, we're not really structured as an ETF at this point. It's more of a bespoke model. So I think what we have to do is clarify these with these listeners that these Triple Y, Saba, and
Invesco.
yeah, Invesco PCF is they are indices. They're trading 50 plus closed-end funds daily within their ETF. What we have is an index methodology, which is 5 years old live, and then we have the back testing to show that it's actually quite robust. So what we're doing is we are more a tailored approach. So we actually take that 50 and we are how can I say we're skimming the top. So we actually created a top 10 as well. So the top 50 is there, and we could actually package it anytime as an ETF. It's just that we're not listed as one. We do it on a customized basis, owning the individual closed-end funds, and actually the top 10, which is a hybrid of the top 50, which is our index.
So I have a suggestion. Well, I made a suggestion and I already implemented it. I'm asking Penny if she ever heard of Selective Top 50 Discount and Yield Index. And she says yes. It's designed to track the performance of 50 closed-end fund CEFs and so on and so forth. And being unaware of who I am, our co-pilot is asking me if I'm considering this index for investment purposes, saying that it could be an interesting way to gain exposure to discounted CEFs. What is our next question? And it cannot be too self-serving. Let's ask Penny difficult questions. Let's be devil's advocate and try to dissuade her from investing in closed-end funds.
Okay, I guess the most natural question would be, what are the risks? That'd be the number one.
Okay, let's ask that. I'm holding my breath. And the risks are leverage,
which we talked about.
Discount premium volatility.
Yep, we talked about that.
Interest rate sensitivity, and you and I both know why.
Yep.
Liquidity risk, management risk,
yep.
Market risk, and that's it. Yep. Six, I call it six love. You know my love to tennis, and basically six love is the perfect set. It's lopsided. It's not perfect to watch, but it means somebody dominates. So this is a pretty good list, but I would be betting on you to now take immediately the opposite position and what would be your, not objections, but saying it's not that simple? Let's look at leverage, for instance.
Yeah, so I mean, the leverage risk is quite common if you are using leverage, whether it's within a closed-end fund or you're borrowing money to invest. It works both ways. So it will amplify returns and it will amplify losses. As long as you understand how that leverage is employed, to what degree it's employed, it can work for you. In terms of against you, it depends on what your goal is. Because we're more income focused, the leverage on income focused closed-end funds or even ETFs is a different animal because you are generating income from there that can help offset. Where the leverage risk can get offside is if interest rates move up sharply. So say we move from the current rate environment into say high singles or double-digit returns, then that's the leverage. There's a cost to that leverage. So that could be another risk is the cost of borrow.
Well, in that case, I would say that if I am a fund manager and I raised $1 billion into my closed-end funds, which normally happens when whatever it is I manage, let's say bonds, are popular, they had a good year. I raise the money and I manage it. Yield curve is my specialty. Is there a chance that I will absolutely miss the fact that my cost of leveraging or of borrowing basically is going to increase if that's my area of expertise? And also, if I have access to borrowing, would my interest rate at which I borrow be one of the lowest on Wall Street or one of the highest?
So I'll answer the last part first. Usually your cost of borrow will be cheaper because you know where to tap the appropriate market to.
You're a street insider.
Yeah, you know where to go to get the leverage and at what cost. Everybody's always willing to provide funds. Just depends at what rate. So that's number one. In terms of managing the yield curve, as you said, yeah, you would hope that person would understand the yield curve duration if they're managing fixed income. Now we're getting a little bit technical here, but you're hoping that they understand how that all plays in the space, and hopefully they have not just federally issued fixed income, but maybe corporate as well, which helps enhance yields because corporates will actually have a higher coupon or interest rate attached to them. So if you're giving it to a specialist like that, there shouldn't be a problem. Doesn't mean it can't happen, but they're managing it for a reason, and they don't want it to blow up either. I mean, they have their best. It's in their interest to manage this properly.
Well, you know what? Leverage gives, leverage takes. Most of the time, and I've been watching closed-end funds since 2002, so it makes me a 23-year, veteran or bird watcher, as I call it, because our embodiment of our strategy is a parrot. so I call it bird watching. And sometimes discounts, are high, sometimes they are low, but most of the closed-end funds are trading at a premium or at a discount.
Usually most are at a discount, just depends on how wide that discount is to NAV. Now that discount and premium volatility also ties into the leverage risk. So it's kind of they kind of dovetail together because if you're applying leverage and rates start moving, well, rates affect not only fixed income, but also affects equity markets, which affects the leverage, which affects the discount or premium volatility. So in fact, the way we're looking at it is that we are harvesting income from that volatility. That's what we're doing, both not only in closed-end funds, but also in ETFs where leverage is applied in, say, covered calls. We are looking to generate, let's call it, for lack of better words, alpha off of the volatility in the pricing.
I like to say it that basically people are seeking alpha, and that's a very popular website and portal for a reason. They're seeking alpha and finding beta. And we are seeking beta and finding alpha.
Yeah.
Which again sounds contrarian, sounds opposite. And that's why we call the strategy Opposite George. We basically seek opportunities. Why don't we tell the viewers a little bit about Z-score? What exactly is that screen, and what is it looking at? And let's keep it simple. How could we simplify it most? Like I'm saying, in Club Dividend Detective, of which you're a head professional, and I kind of conceptualized it at some point. We were talking to co-host, and the co-host said that there's 4 categories of members in the club. And you don't know that, but we had a discussion before. And these 4 categories are basically all people interested in making money, in boosting income, in retirement planning. But there were 4 categories. And they were connoisseurs, contrarians, coaches like you, and clueless. Now, clueless was basically the word that was used in the first article that I read about closed-end funds. It was about Rivernorth. They're very good. They are in Chicago. And they were interviewing 2 managers from Rivernorth, and they called their investors clueless about dividends and about the possibilities and about how it can produce amazing results for income investors. That was long, long time ago. And I said basically that clueless people, given enough clues and given enough, when you simplify it enough, they will still clue in. So clue in somebody who goes into category of temporarily clueless. What exactly is Z-score and why it improved our index from 50 to 10?
Yeah, so without getting technical, or I'll do be a little bit technical here. So the Z-score is really just a statistical calculation, how far you are from the mean or the average. Let's call it the mean for people that aren't mathematically inclined. Anyway, what we're looking for are the closed-end funds that are statistically furthest away from that mean. So getting back to that example I used earlier, let's say the original discount is $9.50 versus a $10 NAV. If the screen comes up and shows us that this closed-end fund at $8.50, which is now a $1.50 discount from NAV, is statistically an outlier. In other words, nobody wants it. We actually pick that up. We actually look for the ones that are outside, buy it, let it close that discount and get back to $9.50. So you get that dollar in capital gain. In the meantime, we're collecting the income as well. So what we're looking for is things that are out of favor as opposed to trying to chase something like a trend momentum model. So not that we don't apply momentum, we do that as well. But what we're not doing is looking for things that are on the move. We're looking for things that have been pushed away and that are at a discount, and then try to pick those up at a good price and let it close that statistical gap for income as well as capital gains.
Well, I asked the co-pilot, and this is this is what the hostess says.
Yeah.
It says they help to identify the outliers. Outliers is a very diplomatic word. I basically call them people who think they know something nobody else does.
Yeah.
Would you agree?
Yeah, I mean, let's put it this way. When you look at the capital markets, all information is basically public. So if you're up, if you think you've got an edge because you got information, technically that's considered insider information. It could be, it is illegal, right? So
It's illegal, and we are excluding that. How many retail investors, people who have RRSPs and RIF, which is basically, and we will talk about it too. Why is it registered money? We will touch on that. But they are no insiders, are they?
No, they're not insiders. And even people on Wall Street, there used to be what they call expert networks, things like that. That was a way of getting around the insider trading. Now, all information should be publicly disclosed immediately. Material non-public information should be disclosed immediately if someone has talked about something. So information is so quickly gathered, digested through algorithms and so forth, that to think that someone has an edge from an information perspective, it's pretty hard. So this is where for us, the statistical analysis comes into play. We look for things that are the outlier to the bad side. We're looking for things that are not in favor at the moment, looking to close that gap. So it's no different than analyzing any other stock where, you look at a stock it's trading at $25, and then you look at the actual, a company has a NAV as well, kind of the breakup value. So if the value of the company is actually $35, you can get it for 25, that's what you buy it. So this is where each analyst kind of, carves up the company, tries to decide what it's worth, and then you decide whether it's a buy or not based on growth metrics, whatever your model is. What we're doing here is really just working on statistics and saying, you know what, it's essentially what they call mean regression. At some point, that will return back to its discount, which is the historical discount.
It's a reversal, and I think that here we should probably mention how we backtested our methodology, and then after that, we will show the viewers CEF Connect and what the co-pilot thinks about it, because, well, for Canadians, I think the best source of information about closed-end funds arbitrage and how to boost your income is you and I, in some way, right?
Yep.
But for somebody like you and me, it would be CEF Connect. And until recently, there was absolutely nothing else. So basically, this is something that tells people that the subject is real. There's significant resources that one of the largest, if not the largest firm that actually makes closed-end funds decided to put into it. It's an extremely rich in information source. It has all kinds of filters. And my suggestion is, and of course I'm biased because, the original index was created and offered to index provider by me. Why not just use CEF Connect, and what kind of information are they giving it? And why is this portal so popular with US-based income investors?
Yeah, well, I mean, there's so many different programs now for investors, and CEF Connect clearly is the leader, in my opinion, anyway, on general information. But just because the information is there doesn't mean that everybody knows how to use it. So you would have to create your model, whatever it may be, or just essentially kind of throw a dart, say, oh, this looks like it's at a discount from net asset value. I'll take a runner on it. So what we ended up doing with our top 50 index is, and this goes into the back testing, we started the index, the start date was what we called the worst time to invest, which was actually at the market high, not at the low. That's the worst time to invest is when the markets are high. So we just recently passed the market highs here. Now we're down from those highs. So the worst time to invest is at market peaks. The best time to invest is on any kind of drawdown or movement to the downside. So when we created the index, we back tested to the peak on the market, and we ran it from there. And we ran it through the crisis, the COVID, and everything else, and it performed very well. So what ended up happening is we took all the data, kind of, I guess, for lack of better words, organized it for our purpose, and chose those funds that were the worst at each point in time. And you can do this, weekly, monthly, semi-annually, annually, whatever time frame you want, and you can actually look at it and say, okay, let's buy these outliers that are to the negative at each point in time for rebalancing. So I'm not sure if that answers the full question there, Yuri, but it goes back to the back testing. We purchased at the top of the market, or started the index at the top of the market, let it run through for 5 years till now, and we just kept choosing the outliers. So The data on CEF Connect is there. People are more than welcome to use it. I mean, it's a great little tool for the retail investor, but is the information presented and then combined in the way that an investor wants it. The thing about these tools is, and we've had discussions before on this, is that it's like a poker game, and this is true for any of the markets where people tend to make the wrong decision at the wrong time. So they'll get out of these closed-end funds as they're dropping in value, and it's kind of like bringing the cash to us. We'll buy it out of the weak hands and then go to the it'll go end up in the strong hands, and that's how Wall Street works. They count on retail to do panic buying and selling to move markets, and you just play against it. So it's not. I don't want to make it sound like it's simple, but it's not rocket science. It's like sitting down at a poker table, and if you don't know who the mark is, chances are you're the mark.
Oh, absolutely. If you, well, it's pronounced much less diplomatically. It's if you don't know who the fish is or the donkey, which basically is the same thing, it's you.
Yeah.
But speaking of which, I asked the Copilot, which is programmed to be considerate, non-offensive, and even with some built-in artificial empathy, if trading against the uninformed people who are making bad decisions is ethical or not. In other words, are you, the professional, responsible for somebody else not doing their homework? And with this comes Warren Buffett again, and the famous quote of that the real risk is not knowing what you're doing.
Yeah, I mean, yeah, I think calling it an ethical dilemma is a far reach, um, because it's not like you are coercing or forcing that person to make that trade to your benefit. You sit back and you wait for that trade to approach you. That's what it is, really. So if the person panics and sells at the wrong time, and you happen to pick up the stock at the right time, then it's how the markets work. I think the ethics of it would come into play where you are coercing someone to behave a certain way to your benefit. So that when you're an individual making your own decision, uh, like I said, it's not knowing the information or how to use it properly, and unfortunately, that's part of this whole, not just closed-end funds, it's part of the whole capital markets game. Money moving from weak hands to strong hands.
That's absolutely correct. And I have to tell you that uh, artificial intelligence came to the same conclusion and told me in, non in a very straight manner that basically there is no issue and that it's considered ethical and normal. And after that, we went straight into comparison of apples to apples, or call them oranges to oranges. I don't know why apples are considered better than oranges, but that's not the point. The point is that to compare our index to the other two that were made into ETFs in the United States, you have to look at the price return index. And instead of asking you, I'll just tell our viewers that it's really simple, because if they are looking at MER and yield, they are missing the point. Is the fund over distributing? Is the fund paying out more than it actually produces in interest, dividend, and capital gains? And is it paying return of capital? In other words, is the investor seeing as income something that is actually his, her own money? And
That's a good point you brought up, because the model is not simply just a statistical arbitrage model or stat arb model, which looks for the outlier. There's a lot of other work within the methodology that looks at exactly everything you discussed. Like, are you paying out too much? How much are you paying? Have you missed a payment? Like, there are so many things that go into the model that we just kind of simplified and said, you know what, we look at things that are outside the reach and buy it. But the methodology is much more complex. We just try to keep it as simple as possible because like you said, if you're getting all return of capital, not necessarily a bad thing, but your adjusted cost base keeps going down. At some point, you'll have a future tax liability. But the other thing is the income sustainable? Have they missed any payments and so forth? So yeah, the methodology is very important, and that's where we worked on.
Again, just kind of running in front of the locomotive, so to speak, or basically just kind of going ahead. If we look in depth on our index price return, which means that every distribution that it paid has been used to finance retirement. And again, we're gonna address the fact why this investment strategy is specifically made and should be considered for larger registered retirement accounts. About that in a couple of minutes later. But the price return of the index that started at 100, the moment it's 90 or 85 or anything lower than 100, any amount of months later, we know that the index is depleting itself. So we are looking at the biggest concern of every prudent income investor, which is, am I eating through my principal? Am I going to outlive my capital, my registered money, and my income? So we know that our index is above 100, both in backtesting and in live record, which goes from 20th of January 2020. What about the other ones? I actually asked AI to do this, and what do you think it is? The findings.
Now you're talking about grind on the investor's capital?
Exactly. We are talking about price return of the other two indices, which is underlying, actually not two, all three of them. I looked at SABA, I looked at YYY, and I looked at PCF. They are all on Yahoo Finance.
Yep.
We can go to the chart. We don't have the time for this, but Penny cannot lie. After I gave her a couple of pointers, it overlaid oranges on oranges and apples on apples. And what do you think the findings are?
If I had to hazard a guess, or let's put it this way, trying to be a positive person, I'd like to think that the other closed-end funds would also kind of at least maintain their $100, the index level of 100. Now it's going to fluctuate over time, but you're hoping that it will maintain that 100 while distributing income. So I'll leave you to do the big reveal here.
They all over distributed. I went specifically to the 20th of January and looked at the price of the unit at that point of the ETF, and then at the dollar amount of all the distributions and what happened to the price of the unit. And let's say that there was $10 paid out, but the unit shrunk by $5. So in reality, yes, and all three of them over distributed, and the only beast in that quartet, because we are the fourth index in the world that I know of. I don't know about any other. And neither does Microsoft Copilot, which has ability to kind of go through massive amount of data in split second, right? Yep. It looks like we have something that might be the best product of this kind in the world. And it's the only one that hasn't been made into an ETF. Your take on that?
Yeah. Well, a couple of things. I mean, once you get into creating an ETF, it's just like any other. Consider our methodology an active management approach because we're always looking for those discounts that are outliers. So it's an active management approach. Active managers, when funds are small, can do very well. But eventually, once you grow to a certain size, that's where those funds tend to struggle because now you're just getting market-like returns or less than market returns. Why is ours better? Is well, we're not in the ETF space. We're not out there competing against Saba, PIMCO, and Amplify on the closed-end fund model. We actually keep it closed and tight just for our clients, especially the top 10. That top 10 is exclusive to our clients. We do publish the top 50 to people who want to explore and play around a little bit. So we do have that data available. But our overlay to bring it to the top of the list with the top 10 is exclusive to my clients. So is it the best in the world? Great. If it is, I don't know. I've never really looked at it, but I'll take your word for it. But yeah, you get to a point where there's so much money in there. Now, we've discussed bringing it to an ETF. And at that point, we would actually probably cap it just to make sure that we don't, for lack of better words, kind of self-cannibalize and bring our returns down. But the top 50 is good and it beats the other indices. It shows that we've got something, and then you want to be able to keep that going forward. So if essentially you do maybe a soft close at first and then a hard close afterwards. But in the meantime, we do have that top 10 model, which is owning each individual closed-end fund directly for the client. So there's no it's not out in the world, so to speak. It's not out for the rest of the world.
You know what, the next question that I'm going to ask right on our screen, and then basically it'll pop up and we'll discuss it. Okay. I will ask our host into what account somebody who considers getting assets for nothing and yields for free.
Sounds like a song.
It's dire straits, yeah. But you know what? There are dire straits. People need income. Bills are coming, they are growing. And if you ask a Canadian investor a decade ago, 2 decades ago, and you know what the mandate is? Income and growth, income and growth, income and growth. That doesn't change. So if somebody wants to use closed-end funds, opposite your strategy, for income and growth, that income and growth should be in one type of accounts. And we are going to ask AI what kind of accounts. What account would you put CEFs bought at discount into? Question mark. Taxable account, tax advantaged account, TFSA is in Canada, and it doesn't mention RRSP. So our intelligence needs a little bit of schooling, and we're going to ask it, why not RRSP? All right. So rookie mistakes. You know, AI makes mistakes. I've seen once a vet, and there was a coffee mug there, and on the coffee mug, he said, please don't mistake your Googling for something that can replace my degree.
Yeah.
The same here. Ability to go through vast amount of data cannot replace knowing what question to ask and how to analyze it. And I've spoken to AI 5 days in a row to see if there's some kind of butterfly effect, if it gives different answers and how consistent it is. And it misses a very simple point every time. The moment you put closed-end funds into RRSP, you all of a sudden remove Uncle Sam's long reach, and Uncle Sam is not taking 15% of your dividend and interest at source. That's one. The second one is, as we already discussed, it's ethical and you are getting a discount from uninformed do-it-yourselfers south of the border who clearly never paid attention to what Warren Buffett said about the risk. So in some way, you're getting a double dip. And I don't want to sound like Costanza in Seinfeld, but this is double dipping. What do you think?
Yeah, I mean, clearly, just looking at the responses there from Copilot, there's some major errors there. First of all, naming it that a TFSA should hold the investments, that's completely
that would be a bizarre error. That would be a rookie mistake.
That's a rookie mistake. TFSAs are not considered registered plans by IRA or the Internal Revenue Service, rather, IRS. So you have to hold it in your registered plans like RRSP or RIF or LIRA. Those types of accounts are considered pension-like accounts. So at this point, there's no withholding tax of the 15%, as you mentioned. If you hold it in a non-registered or a TFSA account, you're going to be withheld 15%, which that means filing for the tax credits and so forth. It just becomes a hassle. So you're better off holding it in your RSP. It's clean. That just closed-end funds. Honestly, any U.S. dividend-paying investment technically should be held in your RSP or RIF or LIRA accounts because you're not being hit with that withholding tax. So I guess the bottom line is hold those closed-end funds at a discount. So first, I guess where the double dip occurs is you're getting the discount. That's the first dip, and the second dip is not being withheld on 15% on the withholding tax. So I have to agree, it's a double dip, and
it is a double dip.
In fact, you can almost say triple dip because the discount from the net asset value, the price of the net asset value, ends up paying for the management expense ratio, MER, which everybody's very sensitive about. So if you have a 5% discount, or say, let's make it easier, you have a 10% discount on your closed-end fund, and your MER or management expense ratio is 2% on that closed-end fund, you're basically getting 5 years of MER for free. So that's
I just asked AI, compare MER and the discount and what is bigger. Very, very simple, right? So, it tries to cover all the things, but basically, how about this? Doesn't discount dwarf the MER often? It's a leading question, but it cannot lie. Yes, in many cases, the discount can significantly dwarf the management expense ratio.
Yeah.
And what else do you need? It's like I said, your MER has been paid 5 years forward. Yeah. And that discount will likely shrink, but your cost will never expand.
Yeah.
Now, speaking of ETFs and of the methods and of the ability to actually use it in a practical manner, why don't we mention in a nutshell what else should a retail investor, I hate the expression retail investor, it's basically somebody who is always on the receiving side. Anyway, prudent income investor, somebody who pays attention, somebody who decided to get retirement ready and basically do something about it. What would be the checklist? What should a person look for? And let's forget for a second that there's not too many, but there's a couple of hundred truly independent advisors in the country who are offering objective, holistic, fiduciary advice. Apart from that, what else should investors be looking for as far as the firm? And let's say 3 most important things. And just to make it more interesting, I will ask our hostess the same question.
All right, so from my side, you want to make sure that you're not being subjected to proprietary product only. So in other words, are they selling you only things that have their shelf name on it? So with Pensionize Me Wealth, we are actually our back office is Design Securities, which is a truly independent firm. We do not have any product per se, but we have whatever we need to suit your needs. So there's a couple of things. I'll use a couple of analogies. I'll use a car analogy and then a car analogy, or sorry, golf analogy and then a car analogy. So the golf analogy is this: I can't. This is where it comes down to choosing an advisor or portfolio manager, which I'm a senior portfolio manager. You have to get down to what is your objective, and each client has a different objective. So a lot of the large bank-owned firms end up slotting people into objectives based on kind of a herd mentality: income, growth, balanced, whatever it is. And you answer five questions, and you're slotted into a model, which is then again their own product. So you're really just feeding that product beast.
That's a lot. There's a lot of questions, but in reality, there's only 5 cookie cutters, and
Exactly.
eventually you will end up in one of those. It's not like the cookie cutter will be made for you. No,
exactly.
You will be formed into the cookie cutter.
Exactly. So the way we approach it at Pensionize Me is, I'll use the golf analogy first. I don't know what you need without talking to you and knowing your objectives. And then from there, only then, so in other words, what I'm trying to find out is, what is your swing like, to use the golf analogy? What is your swing right now? Do you want to improve it? If it's all yeses, then we go to the pro shop and choose the clubs. Now, do we choose all one make of club? No, we'll choose each club from different manufacturers. So in other words, it's even better if the 9 iron is better from this manufacturer, we'll choose that one. And if the 7 iron is better over here, we'll choose that. So we will create a golf bag for you of individual clubs that best suit your needs. And the way we approach that with clients, aside from going to a modeling perspective or running a model for everybody that are clients, is we use a core satellite approach. So core is sort of the base of the foundation, and that core for the most part is kind of common across most accounts. So it's sort of the broad-based markets, call it S&P, TSX, NASDAQ, whatever it is, maybe some international in there, whatever that core looks like. And then satellite is where we get much more specific to the client. So some clients might have a desire for technology exposure, or even more income exposure. So that's where those satellites come in. That's where the closed-end fund can come in. That's where ETFs with an income bent can come in. Or in some cases, if the client wants individual stocks, we'll bolt on those individual stocks into that satellite. The beauty of a core satellite approach is if markets get very volatile and start collapsing significantly, all we have to do is collapse that satellite and go back to just having the core. And then as markets settle down, I'm not talking about market timing, it's just like once we get some kind of settlement, then we can go back to a satellite approach. And then the satellite on the way out might be different than the satellite that we had prior. So we can make adjustments at that time. We don't market time is what I want to get at. And to be out of the market because you think markets are volatile is the silliest thing to do. Right now, yeah, we're going through some tough markets here with the tariffs and discussions about interest rates and so forth and whatnot. But you don't want to be naked to the market because these markets can turn very quickly. So collapse to the core and then build out that satellite. And when you're building out, if you think we've kind of gone through our correction or the downdraft, you can build out that satellite over time. You don't have to jump right back in. You can say, okay, over the next 3 months, we'll add back to these positions based on where the puck is going. So that's the big difference. So I did say I'd use a car analogy. The car analogy is this: I can bring a toolbox, the little red one about this big, or I can wheel in the big one that's at the mechanics store, which is off the floor and has 20 or 30 drawers. That's what we have available. We don't just bring in the little red toolbox, we bring in the big one, and we can have everything in there. And if we don't have it in there, guess what? We can probably find it.
Absolutely. Now, what do you see on your screen on your left?
On my left, just a second here, I see Game of Yield. That's the app
Yes.
that we have.
So let's tell people a little bit about where they are watching or going to be watching our podcast, why they should subscribe to Game of Yield, why Game of Yield is played at Club Dividend Detective Canada, why we have 45. Actually, it's interesting. Our promotion is called Catch 45. Our Profit Parrot talks about it all the time. The ad that led people here starts with Auto, Opportunistic Tactical Trades Optimizer. What are these 45 videos all about? Why should they subscribe? And what I'm trying to say is we created a lot of resources, and some of them go back. I think my first video there is 2008. You and I know each other now for, I would say, 6 years.
Yeah, probably that, if not
Time,
longer. Yeah.
time flies. Time flies. But as it flies, some things that we wanted to do, you think it's for the better. If you remember, 6 years ago, we wanted to do ETF. And now we prefer direct indexing. If you remember, 6 years ago, we were not overly concerned about being with truly innovative independent firm like Designed. And now, especially after I met the founders and you on podcast, I think it's extremely important. And actually, Penny missed it. She said expertise and credentials, which you have, fee structure and transparency, which flat fee for sharp people. If somebody has visited your website and didn't notice how you leave the other in the dust, if you compare simple savings that start from day one of what they're paying for your customized service, and three, of course, is spot on. It's personalized, it's client focused, and I've been customizing my tools, my tennis rackets for, I don't know, at least 20 years, and I play tennis for 50, right? Customization is something that you take very seriously. But again, we have content and we have a firm that lets you be creative in a good way. Creative is not a very good word for financing. Basically, tell me a little bit about how the firm is different. Tell me a little bit about how direct indexing can be better than the ETF, and also why it's important to have somebody, unless you're a sophisticated trader, why it's important to have somebody who will do trades executions, especially because we only trade in December and June.
Okay, so I'll talk about the firm. I touched on it a little bit. So Pensionized Media Wealth Services uses Design Securities as the back office, which is in charge of compliance, custodial services, and so forth through Aviso, which is a very large custodial service. So
don't they serve credit unions?
Credit unions, pension funds, yeah, it's big. Insurance companies actually are backing Aviso. So in terms of client assets, they're secure. We're also under the old IIROC CIRO insurance that applies here as well. So your accounts are covered in case something happens. Nothing should happen, but everyone wants to know that is in place. So we do have the CIRO, which is the former IIROC coverage. So from that perspective, Designed is a very much an independent firm. Each advisor, portfolio manager at Designed is a client of Designed. So I am a client of theirs, and they work very hard to help me grow the business. So if there's new product that may not be available, I can present it to the product team. They will review it and then either approve it or not. And I've been quite successful in bringing some interesting product to Design, open to the whole network at Design that probably wouldn't be available otherwise. So that they do have a product review committee. So Design is truly independent. There is no what do you call it? Again, there's no pressure. I don't have to accept clients because I need to grow my business at a certain rate each and every year. Because when you're at the bank-owned firms, they're always looking at net asset growth, or net new assets is what they want. And everybody wants to grow their business, but the way I approach it is, and we do something called, this is not Pensionize Me Wealth Services, we do something called 20/20 and 20. So in other words, let's sit down, do a 20/20 view of your portfolio and your situation. Let's talk about it. We'll answer the 4 important retirement questions. What rate of return do you need to retire? How much more do you have to save? Do you have to work longer, or do you have to cut back on your retirement to make your money work? We'll answer those 4 critical questions. If you don't know the answer to those right now, or if you haven't had that discussion with your advisor, time to have that. So the 20 and 20 figures out if there is a need for us to engage. And then also you have to take ownership of what we're going to do at Pensionize Me. So if you're not on board with, introducing closed-end funds or whatever is ETFs, income, or whatever, if you're not on board in terms of owning the strategy that's presented, I'm not going to fight for you to become a client. I'm not going to harass you endlessly, because life is too short. If it doesn't work, if we can't have some kind of decent conversation in 20 minutes, then probably it's not going to work. And there are situations where I have turned away business. There just wasn't the right mix. It was very polite and cordial. Just, you know what? I don't think I don't see a fit here. Let's just move on, and let's not waste time. So from that perspective, we're able to do that. Number 3 on your list, which is personal and customized client focus. If you're not interested in that, then that's fine. As you mentioned, the fee structures are transparent. It's on the website. It's right there. So again, Designed approves the websites and everything else, and we're transparent. We don't hide anything. We don't tell you to come into the office or have a meeting before we talk about fees. If you can't see the value for the fees, then that's fine too. Now people will say, well, your fees are low. How can you do it? It's because we leverage technology. We leverage it very much so that we don't need to have everything marked up. That money is staying in your pocket or in the client's pocket. And that money adds up over time. And we have fee calculators on the website. We can actually put in how much I'm paying now, how much will it cost me through Pensionize Me Wealth Services. As far as experience and credentials, I mean, everybody will talk about every credential and experience that they've got. I've been doing this for close to 30 years. I worked at the banks, the senior levels, with high net worth clients and ultra high net worth. I've seen pretty much all the strategies, and it was a great learning curve. But at some point, you just say, you know what, I can probably do a better job for my clients as an independent.
Well,
so
speaking of experience, I'll tell you, there's nothing more annoying than collective experience of 5 people in the team, and 3 of them you'll never meet. 1,000 years experience. Exactly. I put a boardroom and 11 turtles there.
Yeah.
Well, anyway.
So I'll just finish up, Yuri. So then what we do in terms of the Catch 45 and the videos and the game of Yield, there's a few ways to approach Pensionize Me. And that's through, number 1 is just going to the YouTube channel. So you go to the YouTube channel, all 45 videos are there. You can scroll through it and look at it at your leisure. What's nice about the Game of Yield app is that's where we curate all of the content that's in the YouTube, and you'll get updates as things come through the channel. So if you download the Game of Yield app, which is free and it's available on Google Play and the App Store, you're going to get the updates, and you'll have the landing page. You can still work through the calculators and everything else, but you'll always get the curated content, and you can scroll through it at your leisure. So when you do register, you have to give us an email because we want to make sure you're legitimate. But we're not going to harass you. There's a lot of firms that do digital marketing. Well, most firms, I'll say it a lot. Most firms do digital marketing to capture the lead either through your phone number, email, or both, and then they hammer you nonstop until they try to convert you to become a client. We're not going to do that at Pensionize Me Wealth Services. You provide us your contact information. All that's going to happen is you're going to end up on a list, and you will be receiving the updates to the Game of Yield app, maybe an occasional email, but we're not going to harass you to become a client, because that's not our way to grow the business. When you're ready, you will reach out to us and you'll say, okay, you know what? Let's do this 20 and 20. Let me go through the 4 questions. Let's see what's happening. So that's the big difference between the way we're approaching it at PensionIze Me and probably, I'll say 99.99% of the firms or individuals out there.
Yeah, that's interestingly enough, when I was rehearsing our pilot podcast with the co-pilot and training the co-pilot, which has no personality and basically is very pliable, you can tell AI, male, female, what kind of voice, what kind of responses, right? Then I realized one thing. Once that artificial intellect bought the concept and you pointed at the rookie mistakes, like for instance, not understanding that the strategy should go into RRSP, otherwise it loses a couple of very, very kind of positive moments and loses tax efficiency and so on and so forth. At some point, you say, I just want you to be brief. I want radical honesty. Stop complimenting me. And it still goes with, how do you say it, superlatives?
Yeah. I mean, at the end of the day, I mean, I use AI, like we talked about direct indexing and things like that. So the advantages of direct indexing are holding the units individually instead of wrapping it within an ETF because there's something called the total cost of ownership. So
Yep.
you'll have the fee from the portfolio manager, which is me. Then if you put it into an ETF, the ETF has a fee, and then each closed-end fund has a fee. So by the time you fee everything up, it becomes pretty expensive. So that's why our preference is a direct indexing approach, especially when it comes to the closed-end funds. That's number one. In terms of the superlative that you discussed, in using AI, you just can't, as your results show, you can't take that information blindly because you have to understand, let's, for lack of better words, you have to be a subject matter expert of that area. Otherwise, you could be making costly mistakes. And what I mean costly is leaving money on the table to either a tax man or to a portfolio manager or to another firm or what have you. So you have to know your subject matter to be able to structure your portfolio. Everybody talks about financial plans. What we talk about is financial strategy more. It's like what's the strategy? How do we create a strategy to minimize your taxes? You have to pay your tax, but it doesn't mean you have to pay more than you're required to. How do you save for retirement? There's different ways to save for retirement. So these are big expenditures. Taxes, retirement. Next one is we even talk about how to purchase a home if you're buying a home, and that's more relevant with the younger clients I have, where it's maybe the children of my clients that are coming and saying, how do we finance this, or how do I escape through these higher rates? We look at that as well, and then we look at major capital purchases in terms of how do we pay for something. And a major capital purchase is something that you can't buy with your monthly cash flow and pay for it in full. So in other words, you want to buy a car. Car is $50,000. Very few people can write a check out of their monthly cash flow to buy a car for cash. There are people out there. There are, trust me, can actually buy very nice cars, even higher than 50,000. But most people can't. So how do you do those monthly purchases? And then lastly, retirement. So we wrap a lot of things into our process here. And if you don't know the subject matter, the co-pilot or anything, ChatGPT, could feed you the wrong information. If you act on it, then you're kind of on your own. I hate to say it.
Well, we could ask a lot of questions, uh, and there's quite a few remaining. But I think that brevity is a sister of genius or of talent, basically. And very briefly, in your toolbox, uh, there's a tool for financial planning. There's a tool for creating new strategies. We use probably 4 or 5 tools to create content and explainer videos. And all of that basically is something that really serves one purpose, which is create this custom-made strategies and portfolios and monitor them and basically an average retirement is what, 22 years, right? And basically it's a couple of decades of constant monitoring. What do people want? What do you think is the biggest fear? Is it actually, in fact, something that people should be fearful of? Or is there something else lurking that they don't notice? Is longevity and living out your money really the biggest concern that your typical investor has?
I would say it's certainly at the top of the list, just because longevity risk is probably the biggest risk because healthcare has gotten so much better. I mean, my mother is 94 this year. My father passed at 95 5 years ago. So longevity risk is real. And all things being equal, aside from sometimes having a poor diet, the odds of me living older are there. Even with a poor diet, because of the technology that we have, people can live longer. So longevity risk is certainly there. The other thing is a lot of people don't want to be burdens on their family members. So they don't want to tax, what I mean by tax, they don't want to encumber their children or grandchildren or what have you with their longevity. So if they can't afford to go to a home, it becomes an issue. And those homes are not cheap. I mean, you're looking at around $5,000 a month in some places just to have a retirement home. So longevity risk is certainly for real. The other one is when you're looking at an inflation risk. Yeah, we had double-digit inflation here a few years back after the big spend on COVID. But what people don't realize is that your inflation in retirement is actually higher than it was when you were working because now you're getting into the medical side of things. So all those little devices, a walker, a cane, a wheelchair, whatever it is, medication, therapy, physio, all that adds up very quickly. And that's where the big inflation is on those medical services. So inflation risk is bigger than the 2 or 3% that you see on what they call core inflation or CPI. Like there's a bigger inflation in retirement. And most importantly, is that when you retire, every day is a Saturday, and people don't realize that. It's like I'd ask them, "What do you do? What are you doing on the weekend?" "Oh, we're going here, there. We're doing this, that. We're gonna play around the golf, go to the beach, it's everything else." Well, when you retire, every day is like that. So if you want to maintain a lifestyle that you had during your working years, you have to have that money to back it up. So this is where it's very important to have a strategy in place where, how do you combine your CPP OAS with your RSPs? If you're a business owner, should you have, or not a business owner, let's put it this way, if you are an individual who has a benefit of a corporate structure, strategy for your income, should you have an RSP, an individual pension plan, or a personal pension plan? Is there a family that's going to take over a business? So these are all things that have to be considered. So there's a lot of things that are out there, but to get back to it, longevity risk is probably the biggest one, and people don't want to give up their lifestyle. And they say, well, I don't need as much. Well, I tell them, practice now while you can, because see if you can live off of 60% of your pre-retirement income. Give it a shot.
I'll tell you what, I think it's going to be a miserable failure. 60-40 doesn't work even in classical portfolios anymore. But as far as income, 60 and 40 cut, yes. Who are we kidding? Also, that 22 years of retirement, I like the expression, is actually divided into 3 distinct periods, which are called go-go, slow-go, and no-go. And in the go-go, every day is a Saturday and maybe even Saturday and Sunday. In a slow-go, it's no longer a long weekend. But in the no-go, all of that expenses for medical and, they are growing. So go, slow-go, or no-go, costs are there, bills are there, and you need monthly income. And that's what Pensionizer Top 10 and Top 50 do. It's an income engine. I know you are not gaga over the word automation, but I like it. I like it because it's not mechanical. Well, let's put it this way. if we have an index and it tells us to rebalance 20 funds and you have 7 days to do this, and there's a bunch of technical reasons for that. I'm not going to go there. But you have 7 days. And then there is an announcement that one of these funds open ends, which meaning discount will disappear. You will want to buy it. Or that this fund cuts distribution. Will you buy it? No. New information.
Yeah.
Right? Will the index that buys mechanically do this? Absolutely yes. So having a Sherlock Holmes, having a dividend detective, having somebody who's not clueless attached to the index, to me, it's priceless.
Yeah. Yeah, I mean, it's automation in that it saves a lot of the manual work we used to do before, right?
Yes.
So
Yes.
by having an index methodology with additional screening to make it the top 10, it just makes the job easier. So it's rather than automation, I prefer the term systematic because it also takes away a lot of anchoring bias. So, I mean, if you have a bad day or a bad morning or a bad week or whatever, at least the methodology will tell you here's here's the things you need to look at, and then you can sift through it like you said, see if there's any news on any of these funds or what have you, and that's it.
Now let's talk a little bit about something also unique to your practice, which is individual pension plans, personal pension plans, and ability to create extra pension space. And in that pension space, Uncle Sam again doesn't take 15% withholding, and it's more friendly to next generation and wealth transfer. In a nutshell,
Okay, so
what else can they expect in
so
this area?
in a nutshell, RSPs are basically 18% of earned income with a maximum based on that year, less any pension adjustments that you have from your employer. So that's your maximum contribution. When you get to individual pension plans and personal pension plans, it's actually an actuarial calculation. So you'll have more opportunity to put more money away into those plans based on age. So you can actually save more. Within that, when you start pushing the envelope up to the personal pension plan, where if it's a family enterprise, there's an opportunity to pass that down to the next generation and have them assume the assets, as well as in individual pension plans. But with the personal pension plan, you can also have non-qualified assets. So in an RSP, you can't have raw land. In a personal pension plan, you could. So you could have a raw land or real estate. You can actually create your own real estate investment trust.
In other words,
There's a lot more
you have
flexibility.
the same rights to own assets as CPP would. And speaking of CPP, by the way, we talked about closed-end funds in the US and the fact that there's like 400 and something of them, and then liquidity, and we never addressed it. So, and ability to get in and out and go into cash is important, and we don't even have to ask people why, because life happens. They might need a major capital purchase, as you know, the definition is. Big expenses, doesn't matter. Let's tell people how big is the pool of US closed-end funds and what commonly compare it to as far as size.
Yeah, so I mean, the closed-end fund market is very, first of all, very old. It's been around for a very long time.
Over 100 years.
Yeah, over 100 years. I think Boston Properties was the first one.
Yes, correct.
Okay, if I recall correctly. So they've been around forever. It's not a new product. It's nothing fancy. That's flavor of the day. It is used by a lot of family offices, high net worth individuals, because they do recognize those discounts and the ability to harvest the discount and picking up assets. I guess one thing we didn't really talk about is how do you increase your income or boost your income? If you have a closed-end fund at $10 a unit, and all of a sudden it's at a 10% discount, you can now buy effectively about 10% more units of that fund, which increases the distribution because the distribution is based on number of units held. That's how you boost your income, is by buying it at a discount. So how do we buy them? We look, and again, it's within the methodology. I don't want to get into that too deeply here because, or even with clients.
But we were talking liquidity, right?
Yeah,
What
so
I'm saying is that it's so big.
it's
People,
big,
it's
it's
comparable to
liquid.
CPP, right? And I was going to the fact that people don't. CPP came up because you mentioned being able to hold land, right? And then I thought CPP also is very close to the market capitalization of all of this closed-end funds that pay monthly income. They are comparable, and we pick the most liquid of them. So
Yeah, you choose the ones that are most liquid, that are tradable. You don't choose, even though the outlier might be attractive if the volume you can't trade it, we don't. So that's the thing. So, and the other thing is because we focus on the individuals in the top 10, it's a lot easier to pick them off, right? So it's easier to pick off the top 10 rather than having to do the 50 like the competitors do. And our 50 is still competitive, but it's just easier to do top 10 on an individual basis.
less trades and on any test and in any trial, it adds. Well, we're not going to disclose anything. I don't want to go into technical details. The world is full of successful imitators. There's an element of proprietary secrets in there, basically. But tell me about limits to this. Like, any anomaly, any arbitrage, anything. Well, this anomaly has been around for decades. But is there a possibility that somehow it ends? And we know that we even had former client of mine, currently client of yours. We're not going to name names, but in 2008, even that person who's very sophisticated all of a sudden thought discounts, wider discounts are forever. The game changed. And of course, this time it's different, proved to be not true. And the discounts shrunk again. Right? So, what I'm saying is this something persistent? Can we actually eliminate the discount by being successful in attracting people? And why this is a self-liquidating offer, limited time opportunity, why it is unique, and why it's not gonna, I know it sounds salesy, but why it's not gonna be around for too long.
Yeah, in theory, the markets are always big on finding inefficiencies and closing those gaps. It hasn't really happened in the closed-end fund space because I think the individual still acts irrationally. Also depends on the methodology of the competitors, right? So I think there are still opportunities. Can we close that inefficiency on our own? Possibly, depending how big it is. That's why you cap these types of strategies. You sit there and say, okay, if we're going to do a top 50, there's a soft cap at X level of assets, and then there's a hard cap at a certain point because what you don't want to do is, essentially have the head eat the tail, and there's no benefit for the client to be in it. That's where the top 10 on the individual basis is very attractive because for that to be, as called it, self-liquidating, that would be almost, take years and almost impossible to do, and it would be in the billions before that would happen. So I guess what I'm trying to say is the market looks for efficiencies, that they look to close that out, but the arbitrage on the discount to closed-end funds still exists. If it was already done, then we wouldn't be able to pick up these closed-end funds at a discount today. And there's three major competitors out there. So that shows that it's still available.
Absolutely. Do you see your avatar on your screen at the moment?
I do.
Okay. Now, let's go a little bit to the lighter side and finish basically with a little bit of humor. We have a bunch of characters. We have a play deck. We have cards. I'm wearing merch, and my baseball cap says Club Dividend Detective. You are sitting under the same logo, basically. And my obsessive compulsive idea is to create a community of people who not only like strategizing and conceptualizing and coming up with interesting income investing strategies, but basically build a community where people who need information, who are looking for solutions, are coming to the club as what I call club players, amateurs. And you mentioned golf. I've been a tennis player all my life, and I'm a semi-pro. I played college tennis. I don't really need a coach. I could coach, but I don't, because I was always coaching people about investing for income until 6 years ago. Now you are the head professional of the club, but generally speaking, we are creating a community on LinkedIn. It's open to professionals and amateurs. And why should they join the club? Why should they come to you as a head pro? What can you do for them? Why the heck would you offer free app, free content, spend your time on a podcast with me, free tools, and flat fee? It just seems too good to be true. But basically, why join the club? Who should join the club and who shouldn't? And this, I promise, is the last question of the day.
Okay. So who should join the club? Anybody interested in monthly income, to be honest with you, at a reasonable cost. So closed-end funds at a discount. We use exchange traded funds driven by income. We do this all at a reasonable price. Again, everything's on the website. Why should you join the app? Well, the app again curates all content. So when you're on the app, you'll see any new content coming up as we develop these podcasts further, any kind of educational videos and so forth, which brings me to the last part. It's about education. The more I educate my clients, the easier my job is. Like right now, we're going through a very volatile market. I'm getting very few calls, but my calls are honestly more about, when do I get my tax slips? Everything else, not about how the market is doing or, should we sell or buy or what have you. In fact, I'm getting more of the, hey, I've got money. Is this a good time? So I'll say, you know what, send it in and we'll start picking away. So in these days of volatility is a good time to pick away on things that you want to hold long term. If your time horizon is at the end of the year, then we have to rethink the strategy. But as long as it's a long term strategy, and it sounds kind of very industry speak, but as long as the strategy is long term, we can start picking away at these levels on things and maybe lighten up on other things. Like there might be areas that might be under stress. They say, you know what, let's back out. Let's back out of certain areas on strength and reallocate to another area, or hold cash and keep powder dry. So really join because you'll get information. It's education. You'll get curated content. Your content will be curated, and you can approach us anytime after that.
Well, in every area, there's about 15 to 20% of the people who are dyed-in-the-wool do-it-yourselfers. We also have a product for them. Game of Yield app has 2 versions that are subscription-based. But quite honestly, I think that these people will be in significant minority, because with a flat fee, tax deductible between 250 and maximum 750, if I'm not wrong, and what you bring to the table, unless you are the DIYer champion of the world, I would say get the guy, get the pro, and let him handle it. What's your take on DIYers?
I mean, there's nothing wrong with being a DIYer. Some are very successful. I know quite a few that are. But the funny thing is, they keep bouncing ideas off me. So I don't give them specific trades to do, but sometimes they'll ask about a sector or what have you, and I'll give them my opinion. So they're always looking for information, at DIYers. So if you're a DIYer, we have the top 50 indices available, as Yuri said, in 3 different categories. Two are subscription based, one is free.
Yep.
check it out, try it. If it works, great. The information is there. The top 10 is not available to you. That's exclusive to my clients, but at least you'll see what the 50 are. And the top 10 is not just simply the top 10 of the top 50. There's a lot more methodology goes into that top 10.
So there you go. That was Club Dividend Detective Head Professional Ray Dragunas. That was a little bit of a talk show, Yuri and Ray. If some things were not quite smooth, it's because it's the first pilot with Copilot. Now, Copilot can speak. I can even try it to say goodbye. Did you hear that, Ray?
No, I didn't hear anything, Yuri.
That's why. And Penny says loud and clear, she wants to say goodbye. She was very helpful. And there we go. Download Game of Yield, join Club Dividend Detective, and most importantly, book that income boost already. The bills will keep coming, and we're going to help you deal with that. Ray, any parting words? And we're going to be back on Money Monday next time. We will simplify money on Monday at 4 p.m. sharp. Offer flat fee for sharp people and boost your income.
Nothing to add, Yuri.
All right.
Okay.
Bye for now.
Bye.
It's okay.
We'll see you next Monday.
Bye.
Bye-bye.
Okay.